other than why do they make it so difficult? All right. So I already alluded to these 3 different types of assets, asset classes. Let's see. All right, so we got these 3 different types of asset classes. Ordinary income property, 1221 property, which are capital assets, and 1231 property, which is trade or business property. So 1231 property, equipment, furnishings, things, any type of property used in a business, any type of asset used in a business. Ordinary income property, assets that if we sold them would create ordinary income. Now this whole concept of ordinary income is we talked about it a little bit with the dividends, right? Dividends had a special tax rate. Remember that? Think back to chapter 3, was it? I think it was chapter 3, where we talked about dividends, and dividends had that special tax rate. Capital gains also have a special tax rate. They actually happen to be the same special tax rate that those qualified dividends have. So essentially anything that is taxed at ordinary tax rates, those original tax rates that we talked about in chapters 1 and 2, is considered to be ordinary income. So property that if it were sold would generate ordinary income. So the first thing we're going to talk about is ordinary income property. So there is no specific definition except that it says that it is not a capital asset. So anything that's not a capital asset. However, that's not necessarily always so. This chart, by the way, is pretty helpful. So ordinary income assets. These are short-term assets used in a trade or business. Now this is where we're already getting a little bit complicated here, because remember I said this is for like equipment, furnishings, all that stuff used in a business. Well, guess what? Those types of things could be here under ordinary income assets. If it was purchased and sold in under a year, if it's short term, that's what they mean by short term, less than a year. So I purchase a truck in March, I sell it in February. I was using it in my business. Now that is an ordinary income asset because it's short term. It was less than a year. Inventory, already talked about that. So if we sell inventory, obviously if we sell inventory and it's in the regular course of business, that's going to show up on our Schedule C. We're going to have our cost of goods sold section filled out, and that income is going to be part of our Schedule C. It's going to be part of all that. Now it is possible to sell inventory not in the ordinary course of business as well. Like if you sell inventory in bulk because it's old stuff, you need to get rid of it, it's not really in the regular course of business. Inventory is still, even if you sell it in that manner, it's still considered to be an ordinary income asset. Accounts receivable. It's possible to sell accounts receivable. So recall, accounts receivable are amounts that customers owe you, right? You've provided something for them, a service or a good, and they haven't paid you yet. Well, sometimes customers don't ever pay, right? A lot of times they don't like to pay. If they don't pay, then companies will oftentimes sell those receivables to other companies, collection agencies, for example, right? And then when the collection agency collects, they'll give a piece to, not all of it, but they'll give a piece to the original company. Also, there are companies out there that just flat out buy accounts receivable. So if you have accounts receivable on your books of $50,000 and you don't feel like collecting it, it's not worth your time to try and collect that $50,000. There might be a company out there that will sell you or purchase those accounts receivables from you for, say, $25,000, 50 cents on the dollar, maybe. I'm just making these numbers up, by the way. I don't know what the going rate is. Probably lower than that. So the company that purchases the accounts receivable will buy them for half of the price. So you don't have to bother collecting them, but you're getting some money in, right? And then what they'll do is they'll turn around and collect it. They'll collect $50,000 from those accounts receivable. Well, the $25,000 that you collected from them, if you had collected it from customers, it would have been treated as ordinary income, right? It would have shown up on your Schedule C. You would have collected that cash. Just because you're not collecting it directly from customers and instead you're collecting it from another company that is their business model doesn't mean that it's not ordinary income still. Okay, so that is considered to be any accounts receivable collected, regardless of how it's collected, is going to be considered an ordinary income asset. Notes receivable, same thing. So if you have a long-term note receivable, remember the difference between an account receivable and a note receivable essentially is that note has a contract behind it. Okay, so something that somebody has signed. Accounts receivable, you know, there's no real contract other than a receipt or something along those lines. So notes receivable, you can sell those as well. And it'd be the same sort of tax treatment, be an ordinary asset. So those are ordinary income assets. They will be taxed at ordinary tax rates. Those original tax rates we talked about. Next category of assets are capital assets. Any asset held for investment or personal use property. Either of those. Your car is a capital asset. Your house, your personal house, is a capital asset. Okay, these are all personal use property, not to be confused with personal property. Okay, personal use property might be real property or it might be personal property. Personal use property means it's not owned by a business, right? It's yours personally, or you hold it for investment purposes. It's not really defined in the tax code as these items. It's defined by what it's not. It's not inventory, not depreciable trade or business property, not a copyright, which that's a whole other story, not accounts receivable, not notes receivable. So essentially if it doesn't fall under this category, it doesn't fall under this category, then it's this, a capital asset. Okay. Probably the most common one that's known, stocks or bonds. If you have stocks and bonds that you own for investment purposes, that would be considered a capital asset because you hold it with the intent of making money passively off of it, right? But it doesn't necessarily have to be an intangible type of asset like that. It can also be land, buildings, anything you hold for investment purposes. Other businesses. If you purchase like S corps or partnerships, if you're not actively engaged in it, that would still be considered a capital asset. Last category, 1231, trade or business assets. So these are assets used in a trade or business that are long-term, more than 1 year. So that example of the truck that I purchased in March and then I sold it in February, well, instead of purchasing in March and selling in February now, I held it for a full year and I sold it in the following August. Held it for more than 1 year. Therefore, it's no longer an ordinary income asset, it's a 1231 trade or business asset. Okay, so long term, notice it says depreciable. So depreciable assets. Also, long-term land used in a trade or business. Not investment land, but land used in a trade or business. So if you have let's say you have a warehouse and that warehouse is built on land, you know, the whole thing is worth $1 million, but the land itself is worth 200,000 of that million. Well, that land then is a long-term land used in the trade or business, as long as I held it for more than 1 year. Not short-term trade or business property, not inventory, not a copyright. Okay. Ordinary, capital, trade or business. 1221, 1231. Okay, get to know those numbers. 1221, 1231. So when I say 1221, you know that that's a capital asset. When I say 1231, you know that it's a long-term trade or business asset. Like I said, I think this is a really helpful chart. So if you can bookmark it somehow, I would suggest you do that. All right.
Why are ordinary assets not like under like 1211?
What do you mean 1221?
Like why isn't ordinary income assets?
Why don't they have a number?
Yeah.
Because they encompass lots of different types of income. So they would fall under several different code sections. Essentially, it's all the other income. Any other questions? Good question though. Yeah. All right. So let's talk a little bit about each of these. Actually, I already did kind of describe each of these, but we'll go through what the book has to say.